Hi guys. Today we will analyze Advance Auto Parts stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market, but the recent evolution is not positive. The short-term trend is neutral. The long-term uptrend seems to be broken, so, the long-term trend looks negative. Support levels are around $199 and $188. The next support level is around $179. Resistance levels are around $210 and $219. The next resistance levels are around $228 and $235. In the last month the stock has been trading between $191 and $219 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1 million. This is not a very liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth. Even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 3% per year, for last 5 years. We see that the average profit margin of the stock has been around 5% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 126% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Advance Auto Parts Company: bad, average, and good. First scenario. The company will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 4%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $118. Second scenario. The company will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 4.5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $151. Third scenario. The company will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 5%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $188. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 9.53. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Advance Auto Parts, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for the company: bad, average, and good. First scenario. The company will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 16. In this case, the fair value of the stock today would be $78. Second scenario. The company will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 18. In this case, the fair value of the stock today would be $96. Third scenario. The company will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 20. In this case, the fair value of the stock today would be $116. As you can see, today the stock is overvalued, $206, even if we expect the company's high performance in future. Both the profitability and the financial health of Advance Auto Parts get a neutral evaluation. Nothing too spectacular is happening here. While showing a small growth rate, the stock is too expensive at the moment. I'm not interested in this stock at the moment, but I may add the stock to my watch list when it drops below $150. Company strengths. Advance Auto Parts is a leading retailer of automotive parts and accessories in the U.S. The company serves both the do-it-yourself and the professional installer markets. The company operates nearly 5,000 retail auto parts stores in 50 states, Puerto Rico, and the Virgin Islands. The company's earnings have recovered from the impact of the pandemic, and both revenue and earnings are now in growth mode. The company has a clean balance sheet, and management has signaled confidence in its outlook with a 50% hike in the dividend, which now yields about 2.9%. The company also buys back stock. There are opportunities for further growth as the average age of vehicles increases, and comp improvement as the company expands its omni-channel capabilities and increases marketing spending. The company has focused on increasing its commercial business in recent years by improving parts availability and delivery time, as well as by improving relationships with garages. Risks. There are two main concerns: increased competition from Amazon and other online companies, and the possibility of a decline in business as electric cars gain a bigger share of the market. Another risks include an economic slowdown, an increase in fuel prices, lower than expected miles driven that restrain the need for replacement auto parts. Highly cyclical nature of the auto parts retailing industry, which is sensitive to various economic data points. The company has a return on assets of 5%. This is below the industry average of 8%. The company has a return on equity of 20%. This is below the industry average of 31%. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 5% on average per year. The earnings per share will grow by 6 to 8% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.